Mortgage rates ticked higher this week, but they are still below 6.5% according to Freddie Mac. Rates have been on this downward trajectory for a little over a month now. So what does this mean for the housing market? Joining me now, we've got Melissa Cohn, who is the Regional Vice President over at Raveis Mortgage. Always a pleasure to get a check-in with you, Melissa. We've had some of these conversations over the course of the summer, and we've continued to see some slippage in the mortgage rate. That's a good thing for some potential buyers who are waiting to come off the sidelines here. But what do you think that level needs to get down to really see people come off the bench in droves?
I mean, if we want to see, the floodgates open, I would say that the rate has to go down to 5.5%. But the fact that we're down to 6.5% or just below that, well, if you think about it, we were not too long ago hovering in the mid sevens. I think that every 0.25% cut in interest rates will sort of bring that next level or next group of buyers back into the marketplace. And also, as rates drop, we will see sellers who've been locked into their low interest rates, consider selling their property and getting back into the market as well. And that would help us because we really do need more inventory.
What is the key thing that potential home buyers should be listening for in the next FOMC meeting, and even as we're set to get the minutes that come out from the previous meeting?
I think it's going to be, their tone. Are they making this rate cut because of the July jobs report, or, do they continue to start a cycle of rate cuts and that will be ongoing for a period of time? We've seen economic data that has clearly supported the fact that the rate of inflation is absolutely moderating down towards the Fed's 2% goal. But we've also seen, we had that really weak jobs report, but we also had a really strong retail sales report yesterday. So, it's really going to be, what is the strength of the economy and how far does the Fed have to go? And how does the bond market react to it? Because it's really not about what the Fed does. It's how the bond market reacts to it. Mortgage rates are tied to the 10-year Treasury. They're not tied directly to the Fed funds rate.
What happens if you see people both coming off the sidelines and then refinancing at the same time? What does that do to the broader housing market, if there is any kind of net impact that could be anticipated?
Well, I mean, obviously, if people are refinancing, that means that they're not selling, and that's not going to be adding to the inventory. I mean, rates are down, and I think there's been a tremendous amount of pent-up demand for people who have wanted to refinance, either to consolidate a higher rate home equity loan, to pay off credit card debt for home improvement. So, there are more people coming back into the refinancing marketplace, but, there are also a lot of people that will find that, when rates are lower, that modifying the mortgage is not going to give them the home that they want, and that they will in the end up trying to sell and moving on and adding more inventory to us.
And as we were just discussing with our own housing economy and housing market reporter, Danny Romero, the credit that the Harris-Walz campaign is looking to discuss later on today, if they take office and if they are able to kind of move that through Congress, what would that credit do for first-time home buyers from your assessment?
Oh, I think it's a wonderful thing that any grant programs that people can get in order to help them, with down payments or with closing costs, and especially with the new NAR ruling, if they potentially would have to pay the buyer's broker's commissions as well. Whatever we can do in order to get people into homes is the right thing to do. And I think it's a wonderful idea.
Melissa Cohn, who is the Raveis Mortgage Regional Vice President. Melissa, great to check in with you.
Thanks so much.
Appreciate it.